I'd like to simplify technical stock analysis for you. Technical, or also known as momentum analysis, is just one stage of our 5-stage rocket. We begin with general macroeconomic considerations, then we move into looking at the sector and indices, followed by valuation, technical, and finishing up with brand. Not one stage is any more important than any other stage. It's the interlock of all 5 stages that allow you to better optimize your stock choices. Technical analysis really has its genesis with the work of Ralph Elliott. Back in the 1930s, he looked at price share movements, he called them waves, separated them into what is known as fractals, and from that he made future price entry and exit point decisions. What I'm going to do is take all of that technical jargon and put it into 4 groups to help you better understand this part of stock analysis. We're going to begin with moving averages, then we move into reference points, mathematical models, and visuals. Sounds complicated? It's not. Trust me. And all this information is readily available on any financial trading platform. So you don't have to do any computations, you just have to seize the data. Let's begin with moving averages. So what's a moving average? Well, let's say you had a share price of $5, $5, and $8 over 3 days. The average of that is you add up the 3 numbers, you get 18, divide by 3, the moving average is 6. What we're looking at is the 50-day daily moving average and also the 200-day daily moving average. We'll just call them the 50 and the 200. These are the 2 that are most often referenced by analysts when they're providing their projections of particular stock prices. The important thing that you're looking for is for the 50 DMA to be above the 200. When it crosses above the 200, that's known as a golden cross, i.e. a bullish signal. If it crosses below, that's a bearish point and not a good thing. And of course, the best thing on any particular day is that day share price is above the 50 and the 200. The second group we look at are reference points. These are not technical studies per se, they're just reference points. I put them under technical because they're really not part of valuation, as they don't source the 3 financial statements of income statement, balance sheet, and cash flow. And here we're just looking at 3 things, and the first little data bit that we pull out is the relationship between the outstanding shares and the float. The third group of our technical data sets are mathematical models. Now don't turn off the video. I'm going to simplify this for you, and there's just 2 that we're going to look at. The first one is called the moving average convergence divergence, also known generally as the MACD. This uses exponential moving averages, and exponential moving averages, or EMAs, are just DMAs with more weight applied to the most recent data points. In this model, the MACD is represented by a 26-day EMA subtracted from the 12-day EMA. And then another line is created called the 9-day EMA, which again is just the exponential moving average over the 9 days, and this represents the signal line. When the MACD crosses above the signal line, that's a good thing, that's a bullish indicator. When it falls below it, and the MACD goes below the signal line, that's a bearish indicator. So what the chart shows you is these crossover points, and it's usually underneath the chart is a histogram that gives you the difference between the MACD and the signal line. So what you want to see is the MACD above the signal line. That is a bullish indicator. The second one that we look at is the relative strength index, or RSI, which is a look back over 14 days of the share price pace over those particular 14 days. When you see that the RSI is bumping up to 70, that means that the stock is considered to be overbought. And if it's at 30, then that means that it's likely oversold. So you're kind of looking for an RSI that's somewhere in that middle range. Those extreme ranges suggest particular entry or exit points. And it's kind of like the VIX in a way. The VIX is based on the options of the S&P 500. When the VIX is over 30, it means that the market is uncertain or there's fear developing within the market. The last one we look at is visuals. Very simply, just get the chart, you look at it. A double top means that the stock has hit a ceiling, it's found resistance, and it's likely heading downward. You can have a double top, then it's reverse. A double bottom means that it's tested a floor a couple times, it's found support, and now it's going to go on a path up. Similar to that is head and shoulders, where it's a pattern of 3 with the middle point being higher than the 2 outside points. That's the head. Then there's the shoulders. If you see that occurring near the top of the chart, that's suggesting that the stock has found its ceiling, and as it starts to break down below the shoulder, it could suggest that a very bearish signal. And then just flip it, and you can have a head and shoulders on the bottom. It's found its floor, its support level, and now it will start trending up. So these 4 groups of moving averages, reference points, math models, and visuals help you in making your stock choices. Of course, there's so many more technical indicators out there, especially on the math models, where you have trend indexes and on-balance volume studies, S&P oscillators. They're all helpful. I've narrowed it down to the RSI and MACD. I think that's sufficient for you, because they really do give you a visual as well as a numerical insight as to how that stock might be progressing. So thank you for watching. Live long, ascend with joy, and prosper.